Investment projects undertaken will involve the purchase of some assets. At the beginning of the project. And so these assets must be replaced at a certain point in time, maybe before the project ends. So management must set aside some money to replace this asset, and the money they set aside is called the depreciation. But since depreciation is an expense that is not allowed in NPV computations because it is irrelevant cash flow, in order to compensate the business for the depreciation of that asset, tax allowable depreciation is given by tax authorities. Okay, so let's start with tax allowable depreciation. Investment projects undertaken will involve the purchase of some assets. At the beginning of the project. And so these assets must be replaced at a certain point in time, maybe before the project ends. So management must set aside some money to replace this asset, and the money they set aside is called the depreciation. But since depreciation is an expense that is not allowed in NPV computations because it is irrelevant cash flow, in order to compensate the business for the depreciation of that asset, tax allowable depreciation is given by tax authorities. So let's begin with the reducing balance method. Okay. Now the reducing balance method reduces the asset using a specific rate. So let's look at the question. An asset is bought for $10,000 and will be used on a project for 4 years. It will be used on a project for 4 years. For 4 years. To be used on a project for 4 years. The cost of the asset is $10,000, after which it would be disposed of. Tax is payable at 30%. So tax here is saying that at the end of the project, whatever profit the company makes, they will pay tax of 30%, 1 year in arrears. 1 year in arrears. So this means that if the company computes its profit for this year, then they will have to pay their tax in the following year. So if this year is a 20, let's take it that here is 2020, the company will pay its tax in 2021. Apparently, because when companies finish preparing their account for this year, their tax will be computed and they have to pay it to the government in the following year. So that is arrears. And tax allowable depreciation is available at 25% 25% reducing balance method. 25% reducing balance method. Calculate the tax allowable depreciation and hence the tax savings for each year if the proceeds on disposal is 2,500 at the end of the 4 years. So let's go through the computation. So we start with the initial investment, which is in the initial investment. So the initial investment and the initial investment is $10,000. Okay, so let me leave some space here. So we are going to look at the dollar amount here, the tax savings, and the timing of cash flows. Timing of cash flows. Okay, so the first one is, so let's look at here the details. Let's put here the details. And here will be the years. Sorry that I have to do it that way. So then the first one we have to do is that the initial investment, and this one is started with $10,000. On the reducing balance method, the tax allowable depreciation is 25% of 10,000, which will give us 2,500. So we'll subtract it from that, and this one will give us, the balance will give us 7,500. So that becomes the written down value. Now, what is the tax savings? Companies can claim tax savings of 30%. So we compute 30% on 2,500, and that will give us 750. So this is the tax allowable depreciation for year 1. Okay, now since the companies pay tax in arrears, it means that this amount of money will be paid in the second year. Okay, now let's go on and compute the tax allowable depreciation for year 2. It's the same 25% multiplied by 7,500, which is the balance or the written down value, and this one will give us 1875. Now we subtract this from the 7,500, and we are going to get 5625. Now we find the tax savings by multiplying 30% by 1875, and that is going to give us 563. Now this is the tax allowable depreciation for year 2, and since we pay tax in arrears, we are going to pay it in year 3. Hope you understand. So let's look at the tax allowable depreciation for year 3. So tax allowable depreciation 25% times 5625, which is 1406. So we subtract, and we are going to have 4219, and the tax allowable depreciation will be 422 when we multiply this figure by 30%. The timing of the cash flows will be in year 4 because it's 1 year in arrears. Now, okay. Now this is the written down value. Let me write it. The written down value and the written down value going into year 4 at the beginning of year 4. But the asset was sold at the end of year 4 for 2,500. Therefore, we are going to have a disposal of the 2,500, which will give us 2,500 here. So when we subtract that from this one, we are going to get a balancing allowance. So I will explain to you the meaning of the balancing allowance. 1719. And the capital allowance will be 516. That is 1719 multiplied by 30%. So the timing of the cash flows will be in time 5 or year 5. Now let me explain to you the balancing allowance, how the balancing allowance will occur. Let me explain to you why there is a balancing allowance. Now, at the beginning of the 4th year, this is the cost of the asset. Okay? As the cost of the asset, we sold the asset. The cost of the asset, or the saleable value of the asset in the open market, was 42.19. However, since the asset is no more new and we've used it for over 3 years, if you go to the market to sell the asset, we only recover 2,500. So it means we've lost an amount on the sale of the asset, and that amount we've lost is given to us as capital balancing allowance, of which we are going to get a savings of 516. Okay. Now, so this is how we calculate the tax savings, or the tax allowable depreciation and the tax savings. So what is the tax savings? The tax savings simply means that these are monies that are given to the company free of charge, of which it will not be taxed. Later we will look at how to incorporate these cash flows into the NPV computation, so you get a clear understanding of what I'm talking about. Now let's look at the straight line method. Now, in order to use the straight line method, you have to find the depreciation for each year. In order to find the depreciation, it is the cost minus the sales value, or the scrap value, say disposal value, divided by number of years of the assets. So in this particular instance, we have the depreciation equals 10,000 minus the saleable value, which is 2,500, all divided by the number of years of the asset, or the useful economic years of the asset, which is 4 years. So this one will give us 7,500 divided by 4. So 7,500 divided by 4 give us what? 7,500 divided by 4, which will give us $1875. So every year every year the depreciation or the tax allowable depreciation is 1875 for every year. So let's go through the computation. So here we start with the same year. So year, we have details, we have the dollar amount, we have the tax savings, and we have the timing of cash flows. The timing of the cash flows. So let's start with the initial investment. The initial investment is 10,000. The tax allowable depreciation is 1875. Okay, it's 1875. Then 1875 multiplied by 30% times 0.3. We're going to get 562. 562.5, and the timing is in time year 2. So this is year 1, this is year 0. When we subtract this from that, we are going to get 10,000 minus 1875, which is 8125. So this is the written down value for year 2. So tax allowable depreciation for year 2, let me write it well. So this is time 1, time 2. So we are going to record the same 1875, and tax savings is 562.5. This will be taken in year 3. So we subtract that 8125 minus 1875, and this one will give us 6250. So that will be the written down value for year 3. So we calculate tax allowable depreciation for year 3. So tax allowable depreciation for year 3 giving us 1875. Now let's subtract 6250 minus 1875. This will give us 4375. Now the tax allowable tax savings will be 562.5, and it will be taken in the year 4. When we go to the tax savings, the tax allowable depreciation for year 4. So here, written down value, tax allowable depreciation, here will be 1875. Will be 1875. So this one is going to give us 4375 minus 1875, giving us 2500. So the tax allowable depreciation is 562.5. This will be taken in year 5. Now in year 5, written down value, that is year 4, we dispose the asset. We dispose the asset for 2500, and we got 0. Sorry. So here will give us 0. So here will give us 0. So we are not going to claim any tax because we have net of 0 for the asset. Therefore, The only thing we are going to record are the tax savings, the tax savings, the tax savings that we are going to claim. So this is the difference between the tax allowable depreciation, looking at the reducing balance method, and the straight line method. Okay, so let's go on and see what will happen if, let's take it for instance, that let's take it for instance that okay, let me put it somewhere. Okay, let me put it somewhere here. Okay, now let's take it for instance that the disposal amount of 2,500 has changed to say 5,000. What will happen if the disposal amount is 5,000? Will the company get tax savings, or the company, what will happen to the company? So let me clean this part and let's consider that scenario. So now the disposal amount is no more. So the disposal amount is no more 2,500, but now is $5,000. Let's look at the computation. So here the written down value is still 4219. Okay, 4219. So the asset will be disposed at 5,000, the new rate, which is 5,000. Now if you see this, you will see that the cost of the asset, or the saleable value of the asset, exceeds the written down value. So the company is now making excess over the cost, or the value of the asset. Therefore the company is going to, the excess here is going to give us 4219 minus 5,000, and this is 781, and this amount that the company has is in excess of its amount. Therefore the company is going to pay what is called balancing charge. So the company has to refund these funds. So company has to refund so 781 is now a balancing charge. So 781. Now when you multiply 781 times 0.3, you are going to get 234.5, and this will be paid back to the tax. This will be paid to the tax authorities. It will no more be an allowance. For the company to claim here, but this one is going to be a liability that the company has to pay to the tax authorities. Okay.